Some very telling news I want to share with you today as it relates to Morgan Stanley, pretty big player. They have about $27 billion that they finance through debt for the Meta large data center being built out in Louisiana. So I'll explain to you what they're trying to do now. They're trying to basically downsize or eliminate, to the extent that they can, their exposure, to the debt. So let me explain to you, I'll share the story I saw at Bloomberg this morning. Let me first explain to you how they do this, and they're kind of pulling a page out of, or a similar mechanism out of the 2008 playbook. So it's gonna go bad as it did in 2008. Talk about Morgan Stanley is reportedly in talks to execute a so-called significant risk transfer, another term for your financial vocabulary, an SRT, tied to its data center loan portfolio that would transfer the credit risk associated with the loans, not the underlying asset, to outside investors. As we discuss all the time on this show, those outside investors are private credit funds, pension funds, insurance companies. So let me explain to you what an SRT is real briefly, and I'll jump into the story. Before I continue, as I always humbly ask, if you're not subscribed to the channel, please subscribe so we can keep growing the community. I appreciate you guys all being here and watching. So what does the bank do? The bank keeps the ownership of the loan and keeps servicing the loan, and then they slice the risk, if you will, into tranches, or tranches. There's a senior tranche where it's, let's say, the low risk, low capital requirement. They keep that for themselves, of course, and then they pedal off or they shove off all the higher yield, but also a higher risk portion to, let's say, the subclass or sub-tranche, Those are the investors, So what happens then is when losses hit, the first losses have to be taken and absorbed by the investors if the underlying loans go bad. Not if, but when these hyperscalers decide that they're not going to be able to repay these loans because they can't build out these data centers on the time frame or on the budget that they are trying to accomplish. So what happens if we hit a credit, when we hit a credit cycle with this private credit stuff and this AI data center mania? The banks will walk away. They take themselves basically out of the firing line. The private funds and the pensions will get destroyed. So back in 2008, they were using similar type systems, It was collateralized debt obligations, CDOs. Now it's SRTs. They come up with a new fancy language for the next round, So, because what's happening is the SRTs, and they're expanding at a rapid pace. They're expected to expand about 11% globally year over year. So it's turning the banks, it says, into originate to distribute machines again. So private credit funds are becoming the true risk holders in the system. And when, not if, the corporate defaults rise, these investors eat the losses. So the contagion risk then is, spills into the pension funds, the insurance companies, just like happened in 2008. So the banks, this enables the banks, you would say, how is this even possible? I'll explain why in a second, but it allows the banks to basically shove all the toxic portion of these obligations to these investors. And why, you might say, well, why would the investors ever take that on? You know why? Because they get 8 to 12% yield. And so they're yield hungry, they're chasing yield, I should say, not they, but at least the fund managers are, maybe not with the full knowledge, understanding of the individual investors, pension funds, insurance companies, but they're doing it, So that's what the SRT is. Now let me share with you the Morgan Stanley story from today. It's entitled out of Bloomberg, Morgan Stanley considers, and by the way, I apologize on yesterday's video, the afternoon show. I have this new little mic, you see it here, and it's very sensitive. I had it a little bit low on my shirt yesterday. I recorded the afternoon show and it picked up, I didn't know it was going to do it, but it picked up a whole bunch of, as soon as I moved a piece of paper it picked it up in the background. It was very annoying to me when I was watching the video back. I'm sure it was to you guys, so I'll try to do better with that and put the mic a bit higher. So Morgan Stanley, one of the key players in financing the AI race, is considering offloading some of its data center exposure via so-called SRT. Okay, where they're hedging their credit exposure, managing their capital ratios, it says, and freeing up balance sheet capacity, right? The fancy reason for basically, or explanation for shoving all this toxicity onto unsuspecting investors, okay? It does say there's no guarantee the early stage SRT talks will result in a deal. I bet it results in a deal, okay? JP Morgan, some other big banks, Goldman have already put these things in place earlier in the year where they're stepping back, okay? In addition to the Meta platform, the Hyperion data center in Richland Parish, Louisiana, they also, Morgan Stanley, led 3 junk bond offerings, TerraWolf, Cipher Mining, and Applied Digital Corporation, okay? So the strategists forecast, and Morgan Stanley, here's the bottom line. The strategist that says forecast big cloud computing companies will spend about $3 trillion on data center infrastructure projects through 2028. Cash flow can fund only about half of that, the bank estimates, with most of the rest coming via raised via the debt markets, okay? And so they see the handwriting on the wall. They understand that the debt level, debt load is going to continue to skyrocket for these AI data centers, right? With no end in sight. As delays happen, inventory becomes obsolete. There's a problem look at yesterday's video, getting labor, skilled workers to actually build these darn things, okay? So the lending surge, it says, not may, but it does leave banks overexposed, from their perspective, overexposed to a small group of companies, all right? So what do? They shove this exposure to the investors, okay? And by the way, the article does say that Citigroup, JP Morgan Chase and Company, and Goldman Sachs are also among U.S. banks that marketed SRT deals in 2025. So they see what's happening, all right? Too big to fail, right? Global sales of SRTs are expected to expand by an average of 11%, it says, annually over the next 2 years, according to a Bloomberg intelligence survey published in June. So I think that again, should be alarming. Will it change the behavior of these investors, these private credit funds that are going to step in and gladly, with a smile on their face, take on this risk and exposure? No, they're going to do it happily because they want 12%. They're willing to take the risk of getting 0 to get 12% now, all right? And we know the Fed's likely to cut rates again here in a few days. We are in a quantitative easing cycle again, and that is going to put further pressure on these third-party investors through their fund managers, right? They get paid fees and a whole bunch of stuff to make these investments, okay? Or to step into the shoes, if you will, of the big banks. It's going to continue to become a more stressed, more pinched situation as the rates get lowered. The yield reachers are going to only get more proliferate and I say more greedy. And this is going to end, from my perspective, a lot more money in the system, worse than 2008 for a different reason. All right, hope you guys enjoyed the content. If you do, leave me a like. Subscribe to the channel if you're not subscribed. We're growing the community. Leave your thoughts, comments, and questions, obviously, for the live stream Saturday. With that being said, I'll talk to you all soon. Bye.